Welcome to Build Wealth Logically. Calculate, invest, and grow your wealth.
All right, let's talk about one of the biggest money questions here in Kenya. You've heard it a million times, right? Your friends tell you to join a SACCO, it's safe, the dividends are consistent, but then you see headlines about the stock market, the NSE, and you wonder, is that where the real money is made? So where should you actually put your cash? Okay, let's settle this debate once and for all, but we're going to do it with cold, hard data, not just opinions. We're running a simulation. Imagine you had 100,000 shillings 10 years ago. We're going to put it to the test. One chunk goes into a top-performing SACCO, the other into the NSE. After a full decade of real Kenyan market ups and downs, who comes out on top? So let's meet our two contenders in this head-to-head challenge. In this corner, we've got the SACCO, our steady safety net. Think reliable, think predictable, think sleeping well at night. And in the other corner, we have the NSE, the growth engine. This one's all about power potential, but as we'll see, it's a whole lot more unpredictable.
So let's kick things off with contender number one, the SACCO. You know, its main appeal is incredibly simple, and that's its strength, predictability. You pretty much know what you're going to get year after year. It's the very definition of a safe, stable investment.
And this is the number that everybody loves to see. We're using a consistent 12% annual dividend in our model, which is pretty standard for a well-run SACCO. When you plot that on a spreadsheet, man, it looks great. Just a beautiful, steady, upward line. It feels smart, it feels secure. But, and this is a big but, that number doesn't tell the whole story. Yeah, we have to talk about something called real value. See, it's not just about how many shillings are in your account. The real question is, what can those shillings actually buy? And that's where a silent opponent sneaks into the ring: inflation. Over the past decade in Kenya, the average inflation rate has hovered right around 7% a year. Think of inflation as this little thief that quietly eats away at your gains. So that nice 12% you're getting, in terms of actual buying power, the growth is much, much slower. Your statement looks good, but what you can do with that money isn't growing as fast as you think.
Okay, time to bring in our second contender, the Nairobi Securities Exchange. Now, if the SACCO is a calm, steady hike up a hill, the NSE, well, it's a roller coaster. And its value isn't just a number pulled out of thin air. It's tied directly to how Kenya's biggest companies are doing, how confident investors are, and the health of the entire economy. It's a true volatility engine, and that means it can deliver incredible highs and some seriously stomach-churning lows. And this right here, this is the upside. In a good year, something like 2017, you can see how major parts of the market just ignite. When the big telcos and the banking stocks are all performing well, the returns can be massive. We're talking numbers that absolutely blow a SACCO dividend out of the water. This is the power, this is the dream of the stock market. But then you get a year like this, a period where those same banking stocks are bleeding red, and even the giants are barely treading water. This is the flip side of volatility. The journey is anything but a straight line. You can just imagine how hard it is to stay calm and not panic sell when you look at your portfolio and see this.
So, we've modeled it all out. 10 years of steady SACCO dividends on one side, 10 years of actual, historical NSE price swings and dividend yields on the other. So, after all that, it's time to see the final results of our race.
And you know, the way the race played out is actually fascinating. For most of the time, look at this, all the way through year 3 and even up to year 7, the steady, predictable SACCO was comfortably winning. Its consistent returns kept it ahead of the choppy NSE. But then, right around year 8, something incredible starts to happen. We hit what's called the compounding turn. This is the magic of the stock market. It's where your returns start earning their own returns. It's like a snowball effect that turns that slow, linear growth into something explosive and exponential.
So, this is it. It all comes down to this single question. After a decade of steady versus volatile, the safety net versus the growth engine, which one actually crossed the finish line holding more cash?
And the numbers are in. After 10 years, despite all the drama, despite all the volatility, and despite spending most of the race trailing behind, the Nairobi Securities Exchange delivered a much higher return. The growth engine won. But, and honestly, this is the most important part of this whole explainer, that is not the end of the story, because winning the race isn't the same as having the winning strategy.
See, the smartest move isn't to pick one or the other. If you went all in on the SACCO, you would have missed out on some serious growth. If you went all in on the NSE, you might have had a nervous breakdown during the bad years. The real winning formula is a hybrid approach. It's about getting the best of both worlds.
So what does this hybrid approach actually look like? Well, the engineer's choice, based on balancing that risk and reward, is this simple 60-40 split. You put 40% of your investment money into a SACCO for that rock-solid stability, and then you allocate the other 60% to a diversified NSE portfolio to be your real wealth-building machine.
And here's exactly how you can put that into action. Step 1. Build up your SACCO first. Make it your stable financial foundation. Use it when you need a quick loan or have an emergency. Then, step 2 is key. Direct the bigger chunk, that 60% of your new investment money every month, toward the stock market for that powerful long-term growth.
So why is this hybrid model so darn powerful? It's because it lets you have your cake and eat it too. You get to capture all that high growth potential from the market, but you also have a safety net for when things get rough. It gives you access to cash so you never have to sell your stocks at the worst possible time. It takes the emotion out of your decisions and just gives you a perfect balance of risk and reward.
At the end of the day, if you take away just one thing, let it be this. Use the steady, boring predictability of a SACCO to build your unshakable financial foundation. But learn to embrace the calculated, long-term volatility of the stock market to truly build your wealth. The real question was never which one to choose, but how to make them both work together for you.
If you believe wealth should be engineered, not guessed, like this video, subscribe, and hit the notification bell so you never miss the next strategy.